When you hear terms like infinite banking, bank on yourself, cash flow banking, or another version of that concept, what do you think of? Most people think of a whole life insurance policy that is set up for cash value, meaning I'm going to put money into a whole life insurance policy where I'm focused on the cash value, and then I'm going to use that cash value as if it were my own bank, meaning my own source of financing instead of having to go to a bank. Now, how that concept works with respect to a whole life insurance policy is once I've got money in cash value and it's compounding for me, I can access that cash value specifically through a policy loan. Instead of going to a bank for a loan, I'm going to my whole life insurance policy for a loan. When I take that loan, I'm still earning dividends and interest on my full cash value. If that sounds confusing, it is. Here's a breakdown. Pretend you own a piece of property. Say it's your home and it's worth $100,000. The fair market value of your home goes up by 5% every single year like clockwork. If you borrow $50,000 from your property, if you get a loan from the bank for $50,000 when it was worth $100,000, you pay interest to the bank on the $50,000 loan, but the fair market value, it was $100,000 and it is appreciating by 5%. Does it still appreciate by 5% even though you've taken a loan? Yes, it does. You keep earning that 5% on the entire asset. So with a whole life insurance policy, it works identical. If you've got 100 grand in cash value and you borrow $50,000, you pay interest on the $50,000, but you keep earning dividends and interest on the full $100,000. So why people are attracted to this from a banking standpoint is I can fund a policy, have a big bucket of cash value. When an opportunity comes around, I can access this cash value like it were my own line of credit, take advantage of the opportunity, and when I am earning interest on that opportunity, if I invest in my business, for example, my policy is still compounding for me as well. And if I use a life insurance policy instead of a bank, I've got a lot more flexibility and control as far as how and when I pay that loan back. So I don't have to deal with banks, the paperwork, the underwriting, none of that stuff. In a very, very condensed nutshell, that's often why people are interested in whole life insurance for this concept. With that said, a lot of times people still will have buyer's remorse. We see it a lot when it comes to getting a whole life insurance policy for infinite banking, bank on yourself, whatever it might be. So with a whole life insurance policy, when someone is interested in it for this concept, what we hear every single time is I want the highest cash value possible, which I 100% agree with. And the reason why is because if you have the highest cash value possible, that means you have the most possible money to use for whatever you want to use it for. Why would I take a policy where I have less cash value than what I could have had from the get-go? Like, it makes zero sense to me. So this is where the problem pops up. Because with a life insurance policy, I can show you one policy from one company where you pay $1 in and you have zero in cash value in the first year, or you've got 90 cents of that dollar in cash value in the first year. Like, it's a world of difference depending on how I, the agent, decide to set it up. Make sense? Probably. Sound fair? No, it doesn't. Why is it not just straightforward, cut and dry? Well, there's a lot of reasons why. But we'll go through some things that we hear, and then I'll go through what I like about whole life insurance, particularly when it is set up for high cash value. So some things I hear that I don't always agree with. You should have a high base premium. You should pay into a policy as long as possible. Just keep on adding money to it. The base premium gives you a higher dividend than the PUA rider. Why would you stop paying premium into a life insurance policy? You should go with a small to medium-sized company that supports infinite banking and bank on yourself. It's like, what does that even mean? That you can check off the box, this company supports infinite banking on that insurance company's application? If I'm interested in a policy where cash value is the goal, throw out this idea. Because that idea involves taking loans against a life insurance policy. So I would reverse that a little bit. I would look at this. How do I maximize this and then look at loans. Because where buyer's remorse comes into play is never around the idea of policy loans. It's when someone gets a life insurance policy and then finds out after the fact they could have had more money if they only would have known X, Y, and Z, or what the agent didn't tell them. Make sense? Here's what I like to do, and this is how you get the most cash value with a life insurance policy, based on actual data we've seen. A lot of life insurance companies out there, we've seen the 4 major mutual companies deliver the highest cash values to policyholders based on actual proof of performance. You can check out videos on our channel that demonstrate this. I would just type in historical performance or actual policies, and you'll see a handful of videos pop up that document policies that were started in the 1970s, 80s, 90s, early 2000s, where we've got the proof of performance from those 4 companies, and I haven't been able to get it from other companies yet. So when it comes to whole life insurance, like a big problem is an illustration might show good-looking numbers, but then if it under-delivers, I as the consumer am upset. So if I've got proof of performance with certain companies, I feel a lot more comfortable recommending them to someone. Those 4 major mutual companies are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. We'll hear a lot, oh, Mass Mutual doesn't support infinite banking from agents. Well, you've got one of 2 choices. 1, don't use them if you're not comfortable with it. 2, you can still use them and just look to maximize the cash value. And if you want to take out loans, you can do that. Like, is it really for infinite banking? Like, a problem some insurance companies have with infinite banking is that there's certain phrases and terms that they view are misleading. For example, with infinite banking, I can put my money into a whole life insurance policy, get a 6% dividend rate, and pay a 5% loan interest rate. When you hear me say that, what immediately goes through your mind? Get a 6% dividend, pay 5%, positive 1% spread. That term is often used with infinite banking. The big problem with that is that a dividend rate of 6% does not mean you're earning 6%, not with a life insurance policy. In the first year, I'll be negative. You'll see that in an example we'll pull up shortly. I might peak out at about 5% in terms of the annual return. The internal rate of return will be less than that. So let's say you average 4.5% growth, net growth rate on that policy with a 6% dividend. You paid 5%. Now you've got a negative 0.5% spread where expectations were set or you were led to believe you've got a positive 1% spread. Like, that's one example of many where companies are concerned with life insurance being sold and marketed in a manner where they feel like, hey, if people are being misled, we don't want complaints coming back to us. So it really has to do with responsible selling, just from the conversations I've had with these insurance companies over the years. Not all 4, but more than one of them, without getting into details. But aside from all of that, why I like these companies is because of proof of performance. We've seen actual policies, not just good-looking illustrations, and people have been happy because we've seen them deliver. FUD stands for fear, uncertainty, and doubt. I don't want to fall for that stuff or get a policy that's not optimized because of some reason that isn't based on any concrete evidence. Okay, so getting the most cash value. With a life insurance policy, I talk about this a lot. Your money can go toward the premium or the PUA rider. Let's say you're going to pay $1 into a life insurance policy, and you can choose where it goes. Dollars that you pay toward the premium. In the first year, talking about only year 1 here, in the first year, you see 0% of that dollar show up in cash value. Nada. The reason why is because it buys you life insurance. For someone in their late 30s or 40s, a dollar in premium might get you about $50 or $60 in death benefit. So call it a 50x return if you die, but no cash value initially. As you keep paying the premium, it will build cash value. Dollars you pay toward that PUA rider, which stands for paid up additions rider. I like to call it a cash dump-in, because you'll see if I pay $1 there, I'm going to get somewhere between 90 and 95% cash value in the first year. And then that begins to accelerate. This is what beefs up your cash value. But from a death benefit standpoint, it might buy me another $3 in life insurance. If I'm the agent selling you this, which one do I make the most money on? Take a guess. This one. Because if you put money here, the insurance company says, I have to give you, the policyholder, access to the money immediately. Therefore, I can't pay you, the agent, a large dollar amount on this. Whereas the premium dollars, they're giving you death benefit, but that's not going to be paid out until you die. No cash value that they have to worry about you accessing initially. Therefore, they can pay me, the agent, a higher commission. I'm not saying agent commissions are bad, but when you look at where the money goes, it is interesting to see how it works. So let's look at a plan that a lot of people interested in these concepts are shown. We're going to look at an individual in his mid-30s. He's looking at $30K per year for 10 years. That's what he wants to do. But then after that, he was shown an option that keeps illustrating $9K per year going into the policy. Make sense? Here we've got what's called a 30-70 split and then a 10-90 split. What does that mean? Here's what it means. He's paying $30K per year. What's 30% of $30,000? I'm just going to do an approximate here. This is not exact, but it's very close. $9,000 toward his base premium. What is a 10-90 split going to give you in premium? 10% of 30 is $3,000. How much of that premium shows up in cash value? 0%. If you go with a policy that has a high base premium, what are you going to sacrifice? Upfront cash value. The difference will go into the PUA rider. By the way, we're going to look at the exact same company and exact same product here. Total of $30K per year. After the 10-year funding period, we'll look at $9K per year. With option A, you'll just be paying the base premium. With option B, you'll be paying the base premium of $3,000 plus another $6,000 in PUAs, because you can do that. So when we hear you should pay as long as possible, usually it's a strategy that involves dropping the PUA rider and just paying that high base premium indefinitely. That's why a higher base premium is recommended sometimes. I don't agree with it, but that's often why. And then this piece drives me nuts. The base premium gives you a higher dividend than the PUA rider. That is true. It does when you look at the non-guaranteed values. But having a higher dividend does not mean you are actually going to have more money. Because the dividend piece doesn't include the guarantees. More money usually comes from this. So this I just view as a tactic to say, well, you get a higher dividend here, so the money might grow by more long term, therefore go with the high base premium. It's like, no, look at the bottom line. What gives me more money? Okay, let's take a look here. So first, we've got that 30-70 split. 30K per year for 10 years. There's your base premium. There's your PUA rider. The total funding, on the far right, just tallies up all years of paying 30K per year. What's highlighted in yellow, you'll see your break-even point when you get your money back. So let's demonstrate that. By year 7, you've paid in 30K times 7 years, 210, you've got 213. Year 6, you have less in cash value than what you paid into the policy. After the 10th year, in this example, we pay nothing in. We're going to look at continuing to pay in a second, but we just want to start with paying after, or paying only for 10 years, because that's what this individual actually wanted to see. And then, same product, same company, same health rating, just a difference in where his money's going, a $3K premium instead of a $9,000 premium. Forgot to highlight it in yellow. Can I circle it? Let me highlight it this way. There we go. Year 5 instead of year 7. What's the big difference? Up front is a big difference. There's about a $5,000 difference when you look at it net. And then when you look at it long term, where do you have more money? With that 1090 split. What if you scroll down? 90 years old long enough? Where do you have more money? 1090 split. Here's an easier way to do it. We would just have the cash value difference column, laying everything out side by side. So let's look at the same thing, but where we continue to pay premium. So here, we're going to fund 30 per year for 10 years. You can see the 1090 split has almost $12,000 more in cash value than the 3070. Okay, so I'm ahead. Now, I'm just going to pay $9,000 per year. On the left, with the 3070, it's all base premium. At this point, we've dropped the PUA rider. On the right, your base premium is $3,000, your PUA is $6,000. Add the two together, $9,000. So your out-of-pocket is the same. It's the same to the consumer here. Cash value is $370 versus $356. The difference actually went up, meaning it's not how much your cash value increased. This is showing how much more you have with this option compared to this option. So about $14,000 more in year 11 after you add 9K. The next several years up until 50, the gap is widening. As time passes, what do you notice? We're going to pay up until age 65. Like that gap does not close. Same out of pocket. You can look at it long term too, like it doesn't matter. We've got more money from start to finish. And these were policies where again, the design was identical here. There you go. This one's the 3070. There's your base premium. Tiny term rider to prevent a mech. Rest going toward PUAs. There's your 1090. 10% minimum premium. Term riders up here. 30K per year for 10 years. Then we ran different illustrations with the funding ongoing. Point is, the goal here is not to take policy loans or anything. Yes, the individual wants to do that eventually. However, where he wants to start is with maximizing the cash value. Last thing, if the premium is minimized, this is what you're on the hook for. So often we want to see a policy set up where we've got a minimum amount that we're billed for, so it never feels like a burden. I've got the most cash value up front, I get my money back faster, and then I can keep adding more money if I want to, but at the same time, I can stop early if I say, I don't want to have to pay into it for a long time, because you don't have to. So I do hope that this video was helpful. Let us know your thoughts and if you have any questions at all. And as always, I hope this helps.